Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing hedging in Forex. You have no doubt heard the phrase hedging your bets, so what does it mean in financial trading and how can it be applied? The basic principle of hedging your bets in financial trading is to reduce the risk of loss on a trade by counterbalancing the risk of a loss, introducing a second or third trade in some way to offset the risk. There are several ways that traders use hedging strategies to reduce risk. In the vast majority of cases, hedging is used by institutional-sized traders who have large portfolios and will quickly move in and out of an asset dependent on risk-on and risk-off factors, or they will offset some of the risk by hedging strategies. In current market conditions, there has been until very recently direct correlation between the USD-JPY pair and the Dow 30, and where the USD-JPY has been acting as somewhat of a barometer to the COVID-19 outbreak. This will have often been reflected in the Dow 30 and vice versa. In which case, to offset risk, some institutions might reduce the size of the investments in one of the assets and take on a position in the other to reflect the risk appetite. This could be trading the same direction, i.e. going long on both, or even going short on one and long on the other. It is all about the perceived risk. Another strategy would be where the swing trader has a medium-term view of the US dollar index or DXY, where they might be looking for a target of 100.00, rather than just going short on GBP USD. They would prefer to hedge their bets by going short on 2 or 3 pairs, such as the GBP USD, Euro USD, and then perhaps a long position such as buying the USD CAD. All of these trades would favor a long position on the USD, and where the trader would not necessarily require all three to be in profit in order to make this overall winning trade. A direct hedging strategy on a single pair is an entirely different strategy and is usually taken on by traders with large-sized portfolios, who prefer their drawdown or how much they are losing on their profit and loss, or who like to build liquid in a trade, which means that they are being long and short simultaneously on a trade, which usually favors the volatile markets. Let's look at example A where such strategy might be implemented. This setup applies for any currency pair. At position A and B on our charts, we have defined an area of consolidation, which is confirmed by at least 2 points of price rejection along the line position A. This can be confirmed as a level of resistance, and at least 2 points of rejection at position B, which can then be qualified as a support line. In this example, the pair is broken out of the range at position C, and where traders will have started to go short. Now, as we know price action does not move in a straight line, we see periods of pullbacks and further consolidations in the market of trades. But in this example, traders will have gone short at position C and where he or she has an exit target at position X. Knowing that there will be pullbacks, some traders who like to adopt a hedging strategy might go long at position 1, 2, and 3 in order to make some money on the pullbacks. And if they are right, they can get out before the price continues lower, and where at the very least, if price action returns to the previous high, they will have a net profit position which they can then close out. If price action does continue in the vein that we have described, they will get subsequent profit from other pullbacks. As a contingency, they can set a very tight stop loss on their long trades and even bring their stop losses in front of their entry, which is also allowed on some platforms such as MetaTrader 4. This would make their long trade completely risk-free. Traders will also go long and short at the same time on a pair during times of news data releases, and even overnight. Although then, swap rates begin to kick in and tend to work in the favor of the brokers who set the fees overnight lending. Therefore, unless your trading is pinpoint accurate and you're extremely confident with your entry and exit positions, hedging can complicate your trading. But if you have developed a system of accurate entry and exit points with tight stop-loss implication, hedging strategies can be a great way of reducing risk of loss and maximizing profits. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.